Welcome to the deep dive. Today we're hitting Jabil, ticker JBL, big Q4 results, full year, and that critical FY26 guidance.
Yeah, and the mission is really to understand this margin story, right? How they're cutting the low-value stuff and doubling down on AI.
Exactly. It's a fascinating setup because, well, the numbers looked great.
Fantastic, actually. But the stock reaction, not so much. That's the first puzzle for you, the listener. Why the disconnect?
Okay, let's unpack that. Starting with Q4, Jabil really delivered.
They absolutely did.
Core earnings per share, $3.29. That's way above the $2.90 expected, like a 13.5% surprise.
And the revenue, $8.3 billion reported. The forecast was, what, $7.55 billion?
Yeah.
That's almost $1 billion more.
Yeah.
Nearly 10% beat on the top line. That's not just noise. That's real operational strength, maybe taking share.
So with numbers like that, how do we explain the market just shrugging?
Yep.
Or worse, the stock fell over 7% pre-market.
Right, from $225 down to around $210. It's the central contradiction we had to tackle. So the sources point to maybe two things. First, just general jitters. Macroeconomic uncertainty, volatility. Investors getting cautious, maybe taking some risk off the table everywhere.
Okay, so broader market sentiment playing a role.
Yeah. And the second reason, it's more about Jabil itself and its incredible run.
It's been on a tear, hasn't it? Up almost 99% over the last year.
Exactly. So some analysis, like from Investing Pro, suggested that even with the good news, the stock was just trading well above its fair value.
Ah, the classic stretched valuation argument.
Precisely. After that kind of run, investors might have just seen it as a good time to lock in profits. The beat didn't matter as much as the valuation level. Punishing success short term.
So short-term noise, possibly profit-taking on valuation concerns. But the real story, the long-term picture, that's in the forward guidance, isn't it?
And that's where we see the strategy. Let's look at FY 2026.
Okay, lay out the foundation for next year.
All right. They're guiding to net revenue around $31.3 billion. That's about 5% growth.
Solid. And earnings.
Core EPS projected at $11. But here's the really crucial bit, I think. The core operating margin.
Right, they expect that to expand.
By 20 basis points, up to 5.6%.
Okay, 20 basis points. It sounds small, 0.2%. But on $31 billion in revenue, why is that such a big deal?
Leverage. It's all about operating leverage. That tiny percentage shift means tens of millions in extra operating profit, dropping straight to the bottom line. It shows they're getting a better mix, maybe better pricing.
So that margin expansion, that 5.4% to 5.6% move, that's kind of the whole thesis right now.
It really is. It underpins everything.
And near term, Q1 of FY26.
Yeah, guidance there is revenue between $7.7 and $8.3 billion. Core EPS between $2.47 and $2.87. But the engine driving all this, AI, specifically the intelligent infrastructure segment.
Right, AI is the narrative everywhere. How big is it for Jabil?
It's becoming central. They expect AI-related revenue alone to jump 25% in FY26.
Wow, 25%. What's the dollar figure on that?
It goes from $9 billion in FY25, so this past year, up to $11.2 billion next year.
Okay, that's substantial.
And the CEO is very direct. He said Jabil is powering the build-out of AI infrastructure. That's the mission.
Now, 25% growth is great, obviously, but with the AI gold rush happening, should it be even higher? Is that number maybe a bit conservative?
That's a fair question. You see these huge growth rates elsewhere. But remember, Jabil is a massive manufacturer. Scale matters.
True.
So 25% growth on an already huge base is significant. And it might be anchored by, well, physical limits, capacity constraints.
Ah, okay. But they're addressing that.
Directly. Big announcement. A new, huge AI manufacturing facility going up in North Carolina.
Specifically for the U.S. market.
Exactly.
Yeah.
To tackle those capacity bottlenecks stateside.
Yeah.
It's a major commitment.
When does that come online?
Scheduled for the summer of 2026. And it's not just about meeting current demand. It's about positioning for the future.
Setting up for the next wave.
Right. They're talking robust double-digit growth in FY27 and beyond. Once that plane is humming, it hits two birds with one stone, capitalizing on the U.S. AI build-out and adding supply chain resilience.
Okay, let's shift from the big picture guidance and drill down into the segments, starting with that star performer, intelligent infrastructure, or 2.
Yeah, 2 is where the action is. Q4 net revenue was up a massive 62% year over year.
62%.
And Q1 26 is guided up 47% year over year. The strategy here is really moving up the value chain, from just making parts to system-level integration.
System-level integration. What does that actually look like for a customer building a data center?
It means you're not just getting components shipped to you, Jabil is delivering the whole thing. Fully built racks.
Like plug and play.
Pretty much. Compute, networking, power, and critically advanced cooling, including liquid cooling, all integrated. For hyperscalers, this saves huge amounts of time and complexity.
So they're basically becoming the general contractor for the AI server rack?
That's a great way to put it. And within that, they're seeing like triple-digit growth in the core data center stuff, switchgear, PDUs, UPS systems, even chillers, power delivery end-to-end.
That complexity has to be good for margins.
Absolutely. That's the driver.
Sure. Okay, next segment. Regulated industries, RI. This one seems more mixed. Stable, but facing some issues.
Yeah, it's the steady eddy, but with bumps. Overall, they see RI revenue as flat for FY26. Not great, but they expect margin expansion within it.
Where's the drag coming from?
Primarily automotive and transportation. That part is expected to decline by 5% in FY26.
Why the decline there?
It's that volatility we talked about, plus a specific slowdown in demand for battery electric vehicles, EVs, especially seeing that in the US and Europe. Consumers are hitting pause or reconsidering.
So if auto is down, what's holding RI flat? What's the counterweight?
Healthcare. That's the anchor and, frankly, the future high-margin play within RI. It's expected to grow 5% or maybe even a bit better.
What's driving healthcare growth?
A lot of it is drug delivery systems. Think about the infrastructure needed for these blockbuster GLP-1 weight loss drugs, biologics. Jabil makes the devices.
Ah, so very specialized, highly regulated manufacturing. Sticky business.
Extremely sticky. And they're adding capabilities too, sterilization services, CDMO capabilities, especially after buying PII. These projects take a long time to ramp up, but once you're in, the margins are great and customers don't switch easily.
Got it. Okay, last segment. Connected Living and Digital Commerce, or CLDC. This is the one that's shrinking, right?
Yeah, Q4 revenue down 14% year-over-year, Q1 FY26 expected down 16%. But here's the key. This isn't failure, this is strategy.
Explain that. Why shrink intentionally?
It's what you called the margin war earlier. It's a deliberate shift, as they put it. They're walking away from old-school, low-margin consumer electronics contracts, basically cleaning house.
The corporate Marie Kondo analogy again, getting rid of stuff that doesn't spark margin joy.
Exactly. And look at the result. Even though revenue is shrinking, the core operating margin in CLDC hit 6.6% in Q4.
Wow, 6.6%. That's actually above their overall corporate target.
Right. It shows the strategy is working. They're focusing on higher value stuff. Warehouse automation, robotics, complex digital commerce systems. They even mention humanoids as a long-term play. It's about intelligent systems, not cheap gadgets.
That pivot really highlights Jabil's strengths, not just what they build, but how and where. Let's touch on those operational pillars.
Sure. The CEO outlined a few, but the shift in where they manufacture is huge. Their regional footprint.
Meaning more production in certain areas.
Specifically the Americas. Revenue share from the Americas grew from just 25% back in FY 2018 to 46% in FY 2025.
Almost doubled in 7 years. That's a massive shift towards the U.S. Why is that so advantageous right now?
Well, it lines up perfectly with the U.S. AI infrastructure build-out we discussed. Plus, it addresses all the concerns around supply chain resilience, tariffs, geopolitical risk. If you're a big tech company needing secure local supply, Jabil is suddenly very attractive. It de-risks their business significantly.
Makes sense. And another pillar was internal tech use, automation and AI inside.
Yeah, this is how they unlock efficiency and support those margin goals. They mentioned having over 25,000 robots working in their factories.
25,000 robots, that's scale.
But it's smarter than just robots. They use their own AI vision systems for quality control on the production line, catching errors automatically.
And using AI for the supply chain too, right? That's notoriously complex.
Absolutely. They have an AI platform that helps manage procurement. They gave an example of reducing the cycle time to get certain materials from 2 weeks down to just 1 day.
2 weeks to 1 day.
Yeah. Combine that speed with 25,000 robots. That's how you find those 20 basis points of margin improvement we talked about earlier, that operational discipline.
And that discipline feeds right into their financial strength and what they give back to shareholders.
Definitely. Jabil is generating a lot of cash. Adjusted free cash flow was over $1.3 billion for FY 2025. Very strong.
Which lets them make big promises to shareholders.
And they're explicit about it. The plan is to return 80%, of that annual adjusted free cash flow through buybacks and dividends.
That's a serious commitment. What's the track record look like?
It's impressive. Since FY 2013, they've actually reduced their total shares outstanding by 47%. That's huge. It represents about $7.7 billion returned to shareholders cumulatively. It signals massive confidence from management in their future cash generation, even while they're investing heavily in AI and healthcare.
Okay, so pulling it all together, we've got this massive AI growth engine in intelligent infrastructure, really driving things and funding this strategic move into the U.S. and up the complexity ladder.
Right.
And at the same time, they're playing offense on margins, deliberately cutting lower value consumer business to focus on high margin automation and those sticky healthcare contracts.
That's the dual strategy perfectly summarized. Every move, from shrinking CLDC to building that huge North Carolina plant, seems laser-focused on their long-term financial goals.
Which are, remind us.
The official targets are getting that core operating margin consistently above 6% and generating over $1.5 billion a year in adjusted free cash flow. They seem to believe they have the mix, the automation, and the regional focus to get there.
All right, so here's a final thought for you, our listener, to mull over. Jabil is making a huge bet on U.S.-based AI capacity with that North Carolina plant, a big investment. Meanwhile, they're nurturing these high-margin but slow-burn healthcare programs, like for GLP-1s. Historically, underused factories outside the U.S. have dragged on margins. So the question is, how much will this big pivot to complex U.S.-based system engineering finally cancel out those old headwinds? And could FY 2027, when that new AI plan is fully ramped, be the year they truly break through and consistently hit that 6% plus margin target?